doing this a little bit differently this year. We're going to have our kickoff for the budget discussion be actually an overview budget. We will be touching on capital more detailed at our November 18th meeting, but we'll also be looking at our long-term forecasting, which we always do, but not like this all before the select board. We did have the long-range financial planning committee that many of the discussions took place, but it started becoming very repetitive.
Yes.
And in some cases coming to this board somewhat late in the process. So we want to have it all here. We'll still go through many discussions over time, but tonight's the kickoff, and we've actually allocated an hour for this discussion. If we don't need it all, that's fine. But we're not squeezing Pam on the time to keep it to 15 minutes or less. So it's a chance for us to have some discussion. We've invited Finance Commission, School Committee, Long Range Financial Planning, whomever wanted to come tonight. But more importantly, Westwood Media Center, or most importantly, has agreed to then edit this portion of the meeting to make it a link. Not edit it, but cut it out from the rest of the meeting so that we can have this as a link and easier for people to go straight to the subject matter on what we discussed tonight and at future meetings. So we really appreciate their ability and willingness to do that for us. I know some of them around. Thank you, Westwood Media Center. Okay, so I'm going to turn it. Great job. Peanut gallery. I think it's important, so we're really glad we can do that. So I'm going to turn it over to you, but at some point I'd like this to be very interactive,
Yes.
So why don't you guide us?
Absolutely, and I do just want to mention that you mentioned the other boards that were invited, and while some of those members are not here tonight, they know that they can watch this on the Westwood Media, and they intend to do so, as well as we'll send out the material to them.
Great. Okay.
So again, as you mentioned, this is something we do each year at this time to make sure we're going through our financial information before you start moving forward in the budget development for fiscal 2021 budget. So at the meeting tonight, we're going to go through kind of our prior fiscal year FY19 year-end results. We're going to look at the status of where we are with a few key financial items and talk about how those impact the FY21 budget development. And then we're looking at a very early preview of the FY21 budget. At your next meeting, you're scheduled to have the tax classification hearing, where the select board will approve the tax shift between commercial and residential development. At that meeting, we'd be reviewing the residential tax bill. We'd be updating on our actual new growth in the current year, FY20. We'd be updating on the university station revenue and where that stands. I just want to point that out because you will not see tonight's slides on our average tax bill, university station revenue, or our actual new growth. And those are certainly important considerations as we look at our financials and look at FY21. We don't have all of that information tonight. So you'll see those at your meeting in November. As well as in November, we'll start to review the capital budget requests with the select board. We actually will schedule departments to come into you and go through some of the capital that will be requested for FY21. And then in your December and January meetings, as always, you'd continue to refine the budget development, looking further at capital, looking at the municipal operating budget. We'll continue to update and refine our revenue and expense projections, continue that through January. And then on February 1, we're producing the proposed budget book at that point in time, and then that's what gets sent out to the Finance and Warrant Commission and starts their review process. So tonight we're going to start off with fiscal year-end review. And I do just want to make sure to thank all of our financial staff for the work they do to help us close out the year. We had a very smooth year-end close. There is quite a bit of compliance reporting that we have to do both with Department of Revenue and Department of Education. So I'd like to thank the staff, and particularly the staff who's here tonight, who all have some major year-end reporting that they have to do. Our audit and year-end close went very smoothly this year. Our audit is completed. The audit committee will be coming into an upcoming meeting of the select board to go through that with you. So when we look at FY19, we start on the revenue side and look at how did our revenue come in. and the revenue came in quite fine, as it does each year. The pie chart shows our revenue for fiscal FY19, $99 million of revenue. The majority of that, 80%, is in our real estate taxes. All of that revenue on the tax side came in on target, $77 million collected, 99% of our collections on time by June 30th, with no issues. Our residents do a great job in paying their tax bills on time. Our tax collector and the staff in the collector and treasurer's office do a great job assisting taxpayers with their bills. We often speak about how our budget model, being funded by tax revenue for 80%, is a difficult model to work with as we try to budget forward. It's actually an easier model when we look on the collection side. Taxes simply have to be paid. The fact that 80% of our revenue is taxes, it's really always makes for a smooth process. I just want to point out two items. Any past due taxes. As of June 30th, we have two accounts in total for past due. One is tax deferral. There was $455,000 on June 30th. That's a program that the state allows for eligible seniors to defer paying their taxes. They take a lien on their property. They can defer payment of their taxes until they sell their house. The 455 is kind of cumulative from all the years of people being in that program. You can see for prior years, we had 475, FY18, 495,000, FY17. Those numbers show that, we're not continuing to build this account. A couple of new people may come on each year, but a couple move off. It's kind of a rolling number. This is about the approximate amount we have each year. That's a very nice program for those that qualify for that. The second item is tax title. We had just over 600,000 in past due for tax title as of June 30th. Again, that's our cumulative number. We're billing almost $80 million a year. The 600,000 is not just from FY19, it's the cumulative of all past due tax title. Again, that compares quite favorably to FY18 and 17. Again, showing that a few new accounts come on each year, but a few are always rolling off. The treasurer, Gavin, and the treasurer's office work hard to work on the tax title and any past due. It's kind of always rolling. So we are in a really terrific position with our taxes. This is kind of a standard collection rate and activity that you would see for a suburban community who has the housing stock like we do with owner-occupied single-family homes. Looking at our next,
No,
Just-
sorry, no, I'm good.
okay.
I'm good. Thank you.
our next main revenue source is state aid. We took in $6.2 million in state aid in FY19. The bar chart shows our state aid each year for the last several years. And you can see by the graph, it's just been kind of very steady over the last couple of years. No real fluctuations, just very modest, minor increases each year. If we showed you a long-term look at our state aid, you would see something different. The town has experienced years that when the state budget has problems, we might see large fluctuations and decreases in state aid. We've not experienced that for a number of years. It's been very steady. We're now paid that revenue monthly. We've had no mid-year cuts or
How long has
disruption.
it been since we had that mid-year cut?
How long
15
it's
years?
been? I think that might have been
2009.
FY11 or so, yeah.
Yeah.
Yeah, as if it is in the fiscal crisis of 2009, 2011.
Yeah.
And
So just so people know, mid-year, we did have cuts. We had to figure out where cash was going to come from, and one of the reasons we had a prior policy of capital coming back for a second approval was in the event we needed cash
Yes.
resources. We've done away with needing to do that because we've built up our reserves, our stabilization account, et cetera. So we're in just better financial and cash position than we were back when that
Yes, because mid-year cuts are very difficult to kind of
very
handle.
difficult. And I think the state realized that that was a really challenging.
And I think
thing to
that's
do
been
to
part of their
communities.
philosophy and kind of really only going with more moderate increases each year going forward. They're not kind of, trying to reach too high and provide increases only to have to pull back from us.
Right, and we don't rely on it as much as some communities. Some communities are heavily
Yes.
reliant on the state funding for their schools, for many budget items, and so we're lucky we don't have that reliance, but it
Yes.
still is
So it's about
very
6%
difficult
of
when
our
it-
aid for a large city In the Commonwealth, it might be 65, 70% of their
huge,
revenue.
yeah.
I just want to point out one item in green. We had budgeted at town meeting 6.2 million. We had a level funded budget. The actual final state budget was a little bit over that at 6.4 million. So the numbers we're showing on the bottom. We had additional Chapter 70 aid of 160,000, additional municipal aid of 20,000. So the final budget was 180,000 increase over the current year. We can use that number as our starting point when we start to develop the FY21 budget.
What level was that change made at? Was that at the governor's level, or did it happen before it got to the governor?
Governor.
That's what I thought. Did the governor make that
The governor
adjustment?
made that change, and normally we incorporate that change in the budget process. You'll recall
later.
this past spring, there was quite a bit of discussion on increasing the Chapter 70 and changing the Chapter 70 formula. And there was some discussion that that would have occurred for the FY20 budget. It did not. They're continuing to discuss that. So we did not pick up that increase as we normally might in the spring.
Okay.
And then just finally, our third revenue category is our local receipts. Revenue we collect at the local level, primarily our motor vehicle excise and building permit fees. So we had strong collections as we had in prior year, 5.9 million in our total local receipts category. The prior year was 6.1. The revenue in FY19 exceeded our budget by 1.9 million. The prior year exceeded by 2.1. We've talked before that we are conservatively budgeting in this category, so we expect the revenue to come in over budget to those degrees that we just mentioned.
Can you comment on why you recommend and we concur to conservatively budget? I mean, what is the benefit of
Yes.
doing that?
So first of all, we collect whatever we collect. We're not losing revenue. We just are not budgeting and using that in our budget projections and spending the money. When the money comes in over budget, it flows into our free cash, which then we have in hand and we apply in the future year. But the bar graph on the bottom shows the motor vehicle revenue collection for the last several years, 3.7 million. We've had just a little steady increase the last 2 years. This is a category that's that can fluctuate with the economy. This is a category that we took a major hit when we did have kind of the financial disruption in FY08, FY09. It's very hard if you build in and kind of try to capture revenue and then it's pulled back. That can be a big disruption to your budget.
Bless you.
So we have since that point kind of been conservative with the collection on the motor vehicle, the budgeting on the motor vehicle gives us the ability to have a cushion if we saw an economic downturn, that we would not have to come in and change our operating budget at
But
that
you
time.
also look at trends during the year as we are in the budget process. We get that information regularly, right? I mean, we know as the year's going on now,
When we
what's
do our
happening in
monthly- yes.
FY20.
We're doing our monthly budget to actual. We're doing that on both the revenue and expense side, and
So
we're
if you
looking
saw
at
it trending down.
Yes.
Let's say we were in a 2007, 2008 mode and it was trending down, you would pull back the projections for next year's budget
We
right
would know
away.
that, yes. The one thing with the motor vehicle is the main billing. We get the billing from the registry. We don't generate the billing file ourselves. The motor vehicle registry sends out to each community the billing information. We don't get the main one. You get one motor vehicle bill per calendar year. We don't get that till the January, February timeframe for that calendar year. So we often don't know that. We start out with an estimate in the budget. We kind of get firmed up on our collections not until February timeframe.
Okay.
But again, the one other item in there is the building permit revenue. That's also tied to the economy. That's been quite strong the last couple of years with all of the activity in town, new development or renovations. So that's come in quite nicely. So we've had strong collections as we have the last couple of years in the local receipts category. It is built conservatively to provide some cushion. Looking now on the expense side and how did we close out FY19, and I just want to quickly just look first at the snow and ice. budget because that has some impact what kind of year we had as far as what we have for Turnback. So the graph on the top shows how much we spend each year in snow and ice collection, with our FY19 shown in the green bar, $538,000, which was a relatively minor winter for us. If you remember last winter, it was we didn't have too much snow. We did have several major ice storms, but it was relatively minor compared to the two preceding years. So we spent approximately $538,000. Our budget was $450,000. It is the only account, as the board knows, that we're allowed to overspend our budget. No other account can we overspend what town meeting votes, but we can with snow and ice per the state rules. Well, our budget was $450,000. We did a $100,000 supplement at town meeting from the reserve account, so there was a small $12,000 balance returned. The budget was recently increased in recent years. Our current budget, $450,000. Up until FY08, our budget was $141,000 in that account. We were able to then increase it to $250,000, steadily increased it up to $450,000. Having a better budget to begin with puts less reliance on us having to use free cash at town meeting to cover snow and ice or to go to the reserve account. So with a little bit higher budget, and then if we get a more mild a year, you'll see a little bit higher turnback in the reserve accounts at the year end, and you'll see a little less use of free cash for snow and ice.
Do you see any reason at this point to change that $450,000 budget?
I don't think right now. I think that was a great move that the select board did to, bring that up, almost doubling it from the 250. This has given us a little bit extra cushion. We do have, additional free cash to utilize when we do need to transfer.
Okay.
So looking now at our overall close on the expense side. So our operating budget for FY19 was just over $86 million. We vote budgets at town meeting. If budgets are not used, they're returned or closed out at the end of the year. They cannot be carried forward into the next fiscal year. We had turnback of $1.4 million, or about 1.6%. And that's really in line with what prior years have been. 1.2% FY18, 1.3% FY17. The chart at the bottom shows the dollar amount turnback each year for the last several years. So this is really kind of a normal margin. The table on the right shows where that turnback is occurring by category. So in FY19, the turnback of 1.4 million, the $229,000 from the municipal budget, $850,000 from the benefits budget, $333,000 from the reserve account. You can see in comparing that to FY18, very standard. Most of the turnback we see each year is from the benefits and fixed cost account, and then the reserve account. And again, the reserve account is going to fluctuate depending how much we use for snow and ice. The benefits, it's about a 5% turnback each year, and it's simply how we have to budget for that category. We can have fluctuations on our benefits during the year. If new people come online and want to get on the health insurance, we have to have room to allow for that in the budgets. But then if it's not utilized, again, it closes out. So a normal turnback for FY19 in line with where it's been each year. When we combine the revenue turnback and the expense turnback, we then get our free cash certified. And free cash is a process in Massachusetts. The Department of Revenue kind of goes through your year-end reporting, determines in a sense what was your unallocated funds, both on the revenue and expense side. They go through a process of reviewing your balance sheet and checking things. Once they certify it, that revenue is available to be used in future years' budgets. So in a sense, it's the retained earnings left at the end of the year, and then you can go ahead and use those. It does require a vote at town meeting to utilize the funds.
Where did the term free cash
know.
come from, which is so poorly
Poor,
applied? You're saying it's essentially retained earnings. Many people who know financial statements can relate to retained earnings. Free cash conjures up something quite
Yes,
different.
It's not a great term, and the state kind of switched from free cash to unallocated fund balance. I'm not sure if that's any better. But so we try to say it's like retained earnings. One fiscal year closes. Everything in municipal county is kind of year by year. So we close out our revenue, close out the expenses, what's available, now you can use that in the next year. So when we talk about the number of free cash, it's one new number each year, not a cumulative number.
Right.
And you can see by the bar graph on the bottom, what's in blue is the amount certified each year, and the green is what we then spent or appropriated at town meeting. If you look to the far left of the graph, in those difficult years where we had the economy turn down, 09 and 10, we were using basically every dollar of free cash just to get through some difficult budget years. As conditions improved, we could see that we've been more disciplined, we're able to more meet our financial policy guidelines, we're not utilizing all of the free cash. So that means a couple of things. We're more in line with our financial policies. We also have a starting balance. So if you don't use all of your free cash, that's the starting balance that then your revenue over budget gets added to, any turnbacks from budget gets added to get your next number certified. So our amount certified was $6.6 million. Really pretty much in line with where we've been the last couple of years, 5.8, 5.9. Our financial policy says that we'd have approximately $3.3 million in unallocated, unappropriated free cash. So that gives us a healthy amount to utilize in our budget.
No need to change that policy, is there? The
No need to
3.3.
change the policy. But I'm going to show you on the next slide how we've utilized that policy. So this bar graph shows the target of the 3.3 million in the red line. And you can see in green would be our planned use as you start your FY21 budget. As we start the budget, we say, well, let's meet our policy and have 3.3 million unallocated. You can see in the blue is actuals from prior years. We're never quite fully meeting that policy, but we're close. So first of all, we should only use free cash for capital or other one-time uses. And we've been very disciplined in being able to do that. We fund all of our main capital articles from free cash. We then use additional free cash for other capital, snow and ice, as I mentioned, or other warrant articles. Some years there's other warrant articles before town meeting that require funding. So the policy is really just a guideline. It doesn't prevent the select board from doing additional items during the process.
Okay.
So that's really the look at FY19. In good shape, again, a smooth close, a consistent close with what we've had in other years. And now we just go through some key financial areas. Yep.
Pause. Does anybody have any questions at this point? Because we're going to keep going. There's a lot of information here. Is there anybody who wants to interject? Mrs. Delisle, you may, but you need a microphone. That's the price you pay.
I would just like to say, having been on long-range planning and being involved in setting those financial targets, I'm glad to see we finally met the free cash target. I think that's the only one we were never quite meeting, and so I would really encourage us to not go below. If you're going to go below that 3.3, then we might as well then change that target, but keep with it for this year, for going forward, if we can achieve it finally.
Thank you. Okay, proceed.
We're going to look at some key financial areas, update the board on where we stand with those, and then mention if that impacts at all the FY21 budget development. So a number of different areas, and I'll move quickly through this. But the first one is our Stabilization Fund. This is the town's main savings account. It's one of the key items for our bond rating, our credit rating, and we are a AAA rated community, which really helps when we go out to borrow money, helps us get the best rates and save money on interest. So by our financial targets, we should have about $3.4 million in this account. And shown in the green bar right now, we have about 3.3. So we are really on target with this account. It's kind of built up. You can see on the left side of the bar, this is the balance in the account each year, this bar graph. We built this up with one-time revenue. We've just done a small transfer each year for a number of years from free cash just to stay on track. And that's all you would need to continue to do in FY21. Just do the $125,000 transfer. No need to do more. But this is the account. We don't really look to spend this money. This would be what would get us through any kind of economic downturn, reduction in state aid, that type of thing.
So I think that makes sense. This one I would say, not necessarily next year, but I think we should be looking out a little bit further and looking at whether or not to raise that level. I remember back in 2008 or 2005 when what did we had 25,000 in this stabilization account, or 100,000. It was bad days.
Yeah.
And this is great, but as our budget grows, as the town has advanced, I don't want to think that this is the cap forever. So I think we should be looking at a point in time when it's appropriate to
Yes.
increase it.
And years ago, and Mike will remember, we had bad days where we were draining from the stabilization.
The early years.
Yeah.
Yes, so.
We're very fortunate to be at this level. I
Yes.
just think
And it's
we
been
may
a
wanna grow.
steady progression and steady attention to it. And again, it's an important component of our credit rating. So we're not just doing it just to, kind of have money set aside. It is very helpful
Good.
for that. Quickly, a similar look at the OPEB liability, something that we've talked about for a number of years. This is a long-term liability to provide the town's share of benefit costs for retirees, much like a pension liability. The bar graph in this chart shows our annual appropriation towards the liability. And you can see by the chart that we started out quite small. We were able to build up at a couple of points during budget development in a couple of years where we had some savings in healthcare costs and changes in healthcare plan. We were able to build up an appropriation, the appropriation in the current year's budget, $1.44 million. That is really close to the target of what we need to do. So that's terrific. And that has become another area that the credit rating agencies really look at is what's your compliance with OPEB, what's your plan? We currently are on a funding plan and have been for the last couple of years where we increased that annual contribution by $25,000 a year. So really not too significant an increase just to stay on track. And I would recommend that that's our continued funding plan for the FY21 budget. We are required to have the liability updated every other year, and that's where we're just showing you some numbers in that chart on the right. Our next study is currently being done. It's the liability as of June 30th, 2019. The study will be completed in February 2020. We would just point out that we would utilize that information to make any recommendations if needed for changing our funding plan for FY22 and beyond. Not for the FY21 budget. It won't be done in time. So we would increase our budget by $25,000 for FY21, and that'll keep us in very good shape with this liability. The next two slides look at the town's debt. The graph at the bottom shows the total debt outstanding at fiscal year end for a number of years. So in FY19, shown in green, the town has $40 million in debt outstanding. As I mentioned, we have a very strong credit rating, a AAA rating. The last several years have been excellent interest rate environment for the town to borrow money. We did have some large bond sales in FY15 and 16, $10 million in 2015, $16 million in 2016. Those were some of the bonds we issued for the new police station that we're in, the new fire station, as well as some other smaller items. When you look at the bar graph, you can see that when we took on those new debt, our overall debt did accelerate at that point, but then came back down quite quickly. We have not issued any new debt for the last 3 years, as well as some of the debt that was issued, particularly for the fire station, replaced debt that was ending. So when the new fire station came online, was right in line when we stopped the debt payments for the Carby Street Municipal Building. So when new debt is issued, when old debt is rolling off, it helps keep the overall debt steady. We do have 3 pieces of debt that have been authorized by town meeting but not yet issued. So the treasurer has not issued the debt yet for this. And that includes $1.75 million for the first phase of the school project with MSBA, $3.5 million for the redevelopment in the Islington Center and the moving and redevelopment of the Wentworth Library, and $900,000, which was the first piece of the road bond that was approved at the May town meeting. So $6.1 million that we will need to go out and issue. I will point out that the top two numbers, the 175 and the 3.5, are kind of the gross appropriations. They both have revenue estimates that would come in against those, and we would only be borrowing the net amount. So for the 1.75 for the school appropriation, some of that will be subsidized by the MSBA, and we would only be borrowing for the net amount.
But in the case of the school project, we're actually spending money on that now. We just haven't put a bond against it, right? We're funding.
So those are funded as soon as town meeting votes. They're the authorization, the departments can go forward. It just happens that both of those amounts, really the funding is only starting now. As the schools get underway, they've really only recently been spending against that.
Right.
Similar to the Wentworth Library, they were both done in 2018, the approval process, but the actual spending is only occurring now. So the treasurer doesn't need to borrow until the actual spending occurs. But he will be taking action on these items during this year. He most likely will be issuing a short-term ban.
That's what I was wondering,
Yes,
too.
and not issue a long-term bond until further in the year he sees what other new debt might be contemplated for this May town meeting.
And then package them all
package it.
together in one
It's
bond.
costly and time-consuming for the town to go out and issue long-term bonds, so he can issue a short-term ban to cover the funding and then roll that all into
For
a
the
long-term
audience,
bond.
can you say what a ban is, please?
So the ban, is a bond anticipation note.
So
So
it's a
when we go
short-term
out for a
borrowing.
bond, it's like going for a mortgage. It's a long-term, we're committing the town to a long-term 20, 30-year process. The ban or anticipation is a short-term note that can be for a 6-month, 1-year period. He could roll that if he needed to, and then at a certain point, we package it up and put it all into a long-term
I
process.
believe our experience is Westwood's bans or bonds, whichever, are highly desirable in the investment marketplace. We're able to get funding for those very easily.
Highly desirable. And this is something that residents may not understand how we don't go to the bank and borrow money, we have to issue a bond. So investors have to purchase a bond from the town of Westwood, give us the money up front, and we enter
So
into
people
a
in their
repayment
investment
period.
portfolios look for municipal investments all the time, and Westwood is part of that, and they're
And municipal
AAA bond
investment-
rating is when it
AAA
pays
bond
off.
rating, tax exempt, so a lot of investors want that in their portfolio.
Right.
And Westwood's debt is all good debt. We're building new buildings. We're purchasing land. We're improving long-term assets. We typically, when you look at our capital articles, are paying for smaller operating equipment on a cash basis, out of free cash. So we're not borrowing for police vehicles or equipment that will be outdated. We're doing our long-term debt for long-term assets, and that's very desirable.
And I think the bond rating translates into reliability of us paying on our obligations. Highly reliable.
Highly reliable.
Is the 900 been issued? Or is
It has not been issued.
Okay.
So again, he will, the spending now has just been occurring. The treasurer will, need to look at that now, and again, most probably will do a short term, because we typically do a short term if we know other debt is on the horizon, and I think there will be other things coming forward.
So is this, so the work that was just completed on 109, is this 900 to pay for that, or is this additional
No, this is to
Work-
pay for what's already been done.
work that's been done?
That's right.
Okay.
That work that's been done. That was the first piece, if you recall, there was a $4.9 million bond that had been talked about.
We did one.
The first piece, that 900,000, was approved at town meeting. So this piece would be for that. And we did for that piece, when we pulled in that 900,000 into the budget, we do in our current year budget, debt budget, have the funds to pay for that debt service. The other two pieces where we didn't know the timing or whatever, those would come into future budgets. Our current debt budget accommodates the long-term issuance of that $900,000 piece. Just one other slide on debt. When we say we have $40 million outstanding, this looks at how is that being paid off going forward. And there's two components of our debt service. There's debt that was approved exempt debt, which is exempt debt that's approved outside the provisions of Prop 2.5. So a vote was taken at a town meeting and an election to let the town pay for the debt service outside of 2.5. That means the exact principal and interest each year is raised outside of 2.5, and when the debt ends, our ability to tax for that ends. The top chart here shows the amount we're paying, a net amount, for exempt debt. We only have 2 projects right now that were approved as exempt debt, the high school project and the library. So in FY20 in green, those amounts are $1.3 million total. That green is net of MSBA reimbursement that we received for the high school project. So our exempt debt going forward has a natural decline of about $100,000 a year. And then we're pointing out that just in 3 short years, we will make our last payment on the high school.
On the new high school.
On a new high school, and we say this a lot, but I think it's important. That was a 20-year bond. It was the largest bond the town ever issued. We are near the end of the payments for that. That's going to roll quite nicely with the schools as they move forward with their next project, the elementary school project. We'll be able to say to the community, we've completed payments for the high school. So you can see from 23 to 24, there's a $400,000 drop-off that's directly related to the high school debt ending.
And when does the library?
And the library ends, I believe it's 32. I think we issued that in 2012 for a 20-year bond. So we're
But it
moving
was
along
a
on
much
that.
smaller project and it.
Much smaller project.
Yeah.
The chart at the bottom just shows that same debt schedule for our debt within 2.5. So again, in the green in FY20 current year, we paid $3.2 million in debt, which is well within our guidelines, well within the guidelines for what we can have outstanding in debt. That again has a natural decline, and the next one that drops off there is in fiscal 22, a $4 million DPW bond that we had issued for equipment and some road work ends. And again, that would provide space to take on another bond to replace that. So always when we look at debt authorizations as part of the budget, we look to see is there debt rolling off that new debt can replace before we look to add additional dollars within the budget. Just quickly looking at the meals and hotel tax revenue. And we have all of up on top, just more for the fixed slides, the discussion of when we adopted that, what that revenue is. But essentially, the town accepted the local option for the meals and hotel tax revenue, something that was offered by the state. The money comes in. Our town meeting said, set up that goes into a separate fund that only town meeting future vote to utilize can use that fund. So the graph on the left is the annual meals tax revenue, and on the right is the hotel tax revenue. So you can see from when they started, there was a little bit of slow buildup to this revenue. We did close out FY19. We're close to $800,000 a year in the combined revenue. And the little table at the bottom, we're showing you the most recent revenue. We get the revenue quarterly. The state collects the tax and then sends it to us. So our September payment was $114,000 for meals, $94,000 for hotels. So again, on track for just over $200,000 a quarter.
And PM, with the meals and tax, we have historically looked not to build it into a reserve, but to use it for a tactical purpose, to take care of a particular issue.
Yes.
Are we aligned on that again
Yes,
this year?
so this next slide, right, what you're asking, shows the balance in the account and what we've used it for. So in the early years, we did wait to see that revenue come online to see how much it would be and let it build up a bit. But then once it became a steady source, the town meeting has used it to fund capital items, additional projects. So we've done that twice, beginning in the May 18 town meeting, $432,000, and then at the most recent May 19 town meeting, $515,000. They've been used for projects, school, field, the pool, projects that would be hard for us to fit within our ongoing capital budgets, projects that reach the whole community. This has made a tremendous difference to be able to utilize this money towards those projects.
We've talked about, and I think maybe you'll be getting to it, about creating a warrant article that allows us to put some in capital stabilization account or some kind of natural funding mechanism that once, if approved, it will do
Yes.
it each year.
So right now, the town meeting article where we set up this account to hold this money puts 100% of the meals and hotel tax revenue into this account. Another town meeting could change that and put, say, 75% of the money into this account and 25% into our longer-term capital funding. And we're going to show you that account in an upcoming slide. But there are options. It takes a town meeting vote to change that revenue structure. If you change it at town meeting, then the revenue just goes to where you've allocated it. If not, you would need at town meeting each year to kind of vote the money from one place to another.
But no matter what, to spend it, we still need town meeting approval,
And you need a 2/3 vote at town meeting to spend it.
no matter what.
So we ended June 30th.
Yep.
After we utilized funds at the May town meeting, we ended with just over $1 million in this account. We did now have received that September 30th, the first quarter allocation of about $200,000. So currently we have $1.2 million in the account. And so this is a source we'll be talking with you about as you go through your budget development in FY21 about utilizing this funding for additional capital projects. And talking about it, it's a desire to change that allocation going forward. But it's been tremendous revenue. We'll just remind our residents, primarily this is coming from University Station, from the hotels and restaurants there. So it's kind of an added revenue beyond the taxes that project brings. And the town really moved towards adopting this revenue because our residents were paying that in other similar places. If you go to Legacy Place, you're paying that meals tax to Dedham. You go to Patriots Place, you're paying that to Foxborough. So the town adopted this so that we are capturing the revenue from other people coming to University Station. So it's been a nice source to date and will be even more important going forward. So it is the next slide that you just mentioned, Nancy, on the capital fund. So town meeting in previous years, way back in 2009, had set up a capital stabilization fund, an account to try to save towards longer-term capital needs. So if we knew a major capital project was coming, that we could save towards that each year instead of trying to fund that all at once. As you can see from the graph, we really didn't have money for many years to put into the account. And we really have only funded this one time. In FY16, we had a one-time appropriation into the account, and the balance was $1.7 million. In the 2016 annual town meeting, we used $650,000 of this account to do the replacement of the high school turf, track and field. And we really have not had any activity with this account since. We've not put in any additional money. The current balance right now is $1.5 billion. So this account does earn interest on the money in the account. That's why there's a small increase each year.
But Pam, you said we didn't put any in, but it went from $1 million in FY 2017 to almost $1.5 million in 2018. So what was that increase?
I apologize. We had another one-time appropriation in FY18. We had a bond sale that year, and we
and it
took
was
the premium money. Yes. So we should have another little error there under 18.
Okay, thanks.
Yes.
But otherwise, unless we are proactively doing something,
It doesn't
we don't
increase.
have a natural funding mechanism.
We don't have a natural funding into this. So there's 1.5 currently. I will just point out, it'll be something you'll discuss going forward. The second turf field that the town has, the practice field in the back, is
Needs to
now
be replaced.
This may be a funding source for that, as it was for the main.
We'll hear about that in November.
And you'll hear about that in November, about the project.
Yeah.
And then we can talk about this as a funding source.
Okay, great.
The next two slides, not to look at, and I know they're not readable on the screen here, but these
There'll be a
are,
test at the end of this session, everybody, so.
we do self-report
important.
where we stand against our financial policies each year. So this is the most up-to-date information on each of the financial policies we have. Where does the town stand? Are we meeting compliance with that policy? We do post these on our website, as well as we include these in the town meeting book each year.
That goes out from Finance Commission, it's in that one.
Yes.
Yep.
So we do, we don't just have the policies kind of away in a drawer. We are looking at monitoring what is our compliance with the policies. We do send this document to the rating agencies. They love it, that we're reporting. And really, you can see we've got a lot of check marks saying, yes, we're meeting target. The only one we really had not met for a number of years, and we've had tremendous improvement, is in the capital budget. We had policies on how much to reinvest each year in the capital stock, and we've done much better the last couple of years. So the policies and the status kind of ends our look at,
Okay, I'm gonna, to the microphone if you have a comment or a question, please.
No, of course it's a comment, not a
Okay.
question. On the meals tax, I really want to encourage us to set up a policy. We talked about a policy in the past about what we were doing with the money and not spending it every year, and to set up some consistent amount that goes into capital stabilization, because we know there are those turf fields have to get replaced every 10 years. There's also a major, I remember at the time we did the high school, there was a major, I think it's the filtration system or something with the pool, that it's a rather large capital expense that we're probably not saving for. That's a perfect example. So we need to make sure that we're putting some money from that, from the meals tax. I hate to see it kind of going every year to some big project, and we have things that we know we have that are big projects.
Well, I think what we have to do is discuss how to do it, not,
Yeah.
I don't think we have the.
But, I mean, I definitely feel
Okay.
like, I know that, you know, on the meals tax, there is some economic variability with it.
For the
We haven't
record,
gone
could
through.
you identify yourself so we all know who you are?
Barbara
Barb, but-
Delisle, Chair of FinCom.
Thank you.
And just to, you know, we know that there can be some economic impact of the meals tax, and we haven't had an economic downturn since we've been collecting meals tax. So I just would like to see that, you know, that at least we take something off the top to begin with on a consistent basis. It's more consistent with all our other guidelines that we do.
I would just
Thanks for your input.
follow up with one comment
Yeah.
there, that we make sure to use the meals tax for one-time projects,
Mm-hmm.
for capital. From the beginning, when the select board authorized the meals tax to go on the warrant, we said we would never use that for operating budget or ongoing issues, because yes, it is a revenue that can fluctuate with the economy, and we would not want to get caught up in that. So anytime we've used it, it's been for like a one-time.
Yeah, and I like what you said
appropriation.
as well. We try to view it as spreading it around, so there are many, you know, townwide beneficiaries. That's not perfect, but it's served a broad purpose so far, and it will for years to come, and
And we
that's
felt that
good.
those were visible projects that people could see.
Yeah.
Something was
Right.
getting
And-
done,
and
and that
benefit
we could
directly.
tie to
Direct
the meals
benefit,
tax.
yeah.
Yes.
Yeah, that's great.
So-
Any other, before we go on to the next? Okay. Oh, Tony, please. Please identify yourself for the record.
Anthony Mullen, Pond Street in Westwood, Chair of the School Committee. On the debt piece, do you have a sense of what the capacity is, either between within 2.5 or outside of 2.5, that we could take on to be within kind of guidelines for to keep our rating? The debt capacity.
Yes.
Yeah.
And we have another slide on that. I don't have it here tonight, but that is something we typically do show at town meeting. We have a quite large capacity as far as what debt we can take on
Right.
and still be within our overall debt capacity.
We're well below,
Well below.
but we should include that when we get to our capital
do,
discussion.
yes.
Great, thanks, Tony.
Important for people to see that the $40 million I showed in the earlier slides, debt outstanding, may sound like a lot of money, but for our debt capacity, it's not.
And then what it comes to is, you know, practically speaking, what it does for impact on tax bills, what it does if it's within 2.5 to take resources away from other
Yes.
needs. So we're always balancing, even though capacity might be higher.
Yes.
PM, we had for several years applied 500,000 directly to property tax relief.
Yes.
Is that coming up?
Yes.
Okay, I'll hold on then.
Did that 1 year or 2 years? 1 year?
2 years.
Easy
So
to.
we just have a couple of slides just to kind of review where we are in the current year, the budget that was voted at this May's town meeting. Again, just as kind of a reset for as we start to look forward. So the total expense budget, everything that was voted for FY '20, just over $102 million. That was a 3.5% increase from the prior year. The pie chart shows the components of the budget, and by far the biggest thing we spend on every year, typical for a suburban community in Massachusetts, is our school and municipal operating budgets. So really our spending is to provide those annual services to the community. And we really have strived to make sure that the budgets we vote for those areas are sustainable and stable each year. Much like we talked about before, we're not trying to have wild fluctuations in the budgets for our school and municipal departments year to year. This chart just looks at, for our operating budget in FY '20, $94 million. The components with the school in blue, $46 million, municipal in red, $22 million. Our fixed cost budget, $15.2, and our debt service, $6 million in green. This chart at the bottom shows the increase each year in the school and municipal budget. You can see in the most recent years, FY '18 to '20, we've been in that 3.5% range, and that's really our sustainable level under Prop 2.5. On the left side, FY '16, '17, we exceeded those amounts, just over 5% in FY '16 for school and municipal. It takes additional revenue for us to be able to do that. In those 2 years we have noted there, we were able to use some of the additional revenue coming in from University Station. But really our more sustainable growth is in that 3.5% year. And that is what we strive for with the operating budget, is to try to have budgets that fund what is needed for good service delivery, but that are sustainable going forward. This chart just is a reminder of where we were with that capital budget in the current year. FY '20, we voted for our base school and municipal capital, $2.3 million. You can see that that's a significant improvement over where we had been for a number of years. Our financial policies indicate we should be spending about $2.4 million on our ongoing capital, taking care of our buildings, rolling over our capital equipment. Our public safety and DPW departments are highly relying on their equipment for service delivery. For many years, we were spending only $800,000 for capital for school and municipal. We've tried to increase that each year. With the $2.3 million, we're almost 3 times what we were doing for a number of years. So we've much improved there. But because we were under target for so many years, the town has, in the last couple of years, presented and had approved by town meeting additional capital above what we're calling the base. So when we increase the base to 2.3, we're trying to say we can commit to that level every year. Here we're coming in saying, can we do more for capital? Again, trying to make up for those years that we've not. So the chart shows for the years that we've done the additional capital article, $750,000 FY '17. We were actually able, in the current town meeting in May, $1.3 million. We're funding this additional capital with free cash and meals and hotels. Again, here we're trying to get at large items that really are difficult for the school and municipal to fit within their regular capital allocation. So we've listed here a couple of projects that were done. Large pool renovations, lighting up the high school tennis courts. The schools had a large IT network project. In the current year, we're doing some HVAC at the Thurston and the COA and some design for field projects. So this has allowed us to really kind of pick up on capital where we hadn't been for a number of years. Just closing out our current year, we still have a few things left to do in the current year in FY '20, really around values and tax rates. And as I mentioned, you'd be doing that at your next meeting. So we are just now getting final values and approval for all of the FY '20 values, including whatever our new growth is. Department of Revenue actually has to certify our values that the assessing department puts together. We'll have our tax rate at your November meeting. You'll have your hearing to allocate the shift from commercial to residential. We then submit and get our tax rate approved by Department of Revenue. At that point, we actually know what our actual residential bill is for the current year. So again, we'd be reviewing that with you in your November meeting. And finally, I just want to mention the capital budget. We did have a couple of items that were held over in the spring when you were completing the capital for the current year. So these would be the first items that we'd be reviewing. At one point, we had thought if we had a fall town meeting, we might review them then, but now they'll be the first ones. It was the field lighting project, the fire department equipment, and the other pieces of the road bond. So you'll be seeing those coming.
And Mike, if he gets the road, if we were to do a road bond in May, is that too late for him to do some of the work in the summer?
No, he would, the idea would be to bid it out early, get it already teed up, and if the money got approved, then he could go forward.
Hey,
I don't
John,
know that portion of 109 has a year left.
Todd holds off a lot till school's out.
Yeah, but if we didn't get the approval to May, John's wondering would it
I didn't
actually
want
be
him
able
to
to
start
happen?
bidding at that point.
Yeah.
Yes,
Yeah, I
can-
think he
can
gets a head
bid
start.
He can bid
Subject
in
to
advance.
funding.
Yeah.
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 We can ask Todd more about that too, I
And
think, when he
he's
comes in.
coming in November
Yeah,
meeting, yep.
Yeah. Because there is a magic to the process he does to get out ahead of things that
Right.
I
Yeah.
think is really worth hearing
He
about.
likes to bid out early in
Yeah.
the winter, because that's when everybody's trying to get their work lined up for the
One of the
next
reasons
year.
things are
Yeah.
often done,
If the sidewalks look so
early part.
good, he now needs to come behind it and
Yeah,
do the roads.
yeah,
They do look terrific.
yeah,
Big quality of life improvement.
yep.
So we're just going to finish with a quick look at the year ahead.
Okay. Now we're down to the quick look.
Yeah.
Quick look.
That hour,
5 minutes.
that hour has filled it up, Pam. Go ahead.
As always, when you look at the next year budget, you have some overall goals. Trying to maintain the high level of quality service provided by the town and school departments. Trying to maintain moderate growth and sustainable budgets. Continuing the high level of capital investments. It's important to maintain the town's assets, so we're continuing with a higher level of base capital as well as additional. Continuing the compliance and the progress we've made on those reserve and liability accounts. Beginning to discuss and incorporate these larger long-term capital items that are now coming, the school building project and other municipal, and then continuing efforts that you've done over the last several years on trying to limit the tax bill growth. And so part of your budget process is to review what are the tools that you have. And there's several. Not utilizing the full tax levy, applying free cash to the tax rate, keeping capital within Proposition 2.5. And really, you've done all of those over the last several years. So we'd be going through those options with you and showing numbers as you start to do your budget. But those would be the items that you would look at.
Thank you.
As we go forth now and start to do the 21 budget, we start with, what funds the budget. This chart shows in the current year, as we talked about, we're funded fully by taxes, then state aid and local receipts. So as we develop our FY21 budget, we look at how does this revenue change going forward. I just have a quick slide here, the next slide. Calculating the taxes, because Prop 2.5 is a formula, is very easy. This chart is showing you how we do that for the current year's budget. As I mentioned, we don't have all the up-to-date information to do this yet for FY21, but it is a simple process. Prop 2.5 lets us increase our prior year by 2.5%, then add estimates for new growth. And that comes up to the limit on what we can raise in taxes. So we'll go through this chart when that happens. This chart shows the last several years of our tax levy growth. I will point out the town has not had a general override since 2007. That's really kind of a remarkable long-term period, considering what we've been able to do for the municipal and school budgets during that time frame.
So is that for FY 2007?
I think it was voted in 7 for FY08. So almost a
13.
13-year period. So we'll go through this once we have all the final information, but it's really our starting point for our budget for 21, is what do we have in new revenue? And under Prop 2.5, it's a very restrictive process. It really doesn't matter what you might want to do. It's just a calculation from prior years. So we know on taxes that from our increase of 2.5 and our normal estimate for new growth is about $2.5 million. So we would have $2.5 million more in FY21. That number will be updated based on what our final closeout for new growth was in FY20 and what our final university station estimates will be. So it'll be some number higher than 2.5 million. And really, that's our main increase in revenue for FY21 to start our budget.
Pam, when we talk about 2.5 million in new revenue growth from property taxes, we also have money from the motor vehicle excise tax that we could utilize, money from building permits we can utilize, right? I'm just hypothetically.
Yep.
Meals tax, obviously, we have 1.2 million, and we're over on free cash. So although it's 2.5 million, we do have other pockets of money that we can use.
Yep, so we're just, the taxes is 2.5 million. So when we look at a budget, so we're balanced in the current year. So our revenue balances our expenditures. When we're doing budget development for the next year, for fiscal 21, we're saying, what increase in revenue do we have? and then we would be able to apply that to increases in expenses. So our taxes is 2.5 million plus those couple of other items. We will then have, what's that increase in state aid? So will we have
Be
additional
100,000.
revenue?
Right.
We then say, what increase do we have in local receipts? Do we want to increase that budget? We typically, in early budget development, level fund the state aid and the motor vehicle. We're here now in the fall, we're not really voting your final budgets until March, so we typically start out level funded, and then we would look to monitor that during the year and increase at that point. And then absolutely, as you said, a big piece is, what are we going to utilize of free cash to build into the budget? What are we going to utilize of the meals and hotel tax? So both of those revenue, we're kind of using what we already have in the bank
Right. Right.
versus kind of projecting out.
But again, the meals and hotel tax, we don't use for operating budgets,
Correct.
which
So
is
not used for
largely.
operating.
I want to make sure that,
One
Yes.
time.
I know you've said that before.
And the free
you
cash
said it.
also.
I want to say that again.
Not part of the operating
Well,
budget.
there's always competing interests, right? I mean, any year. And so I don't want to leave people with the sense that we have 2.5 million to look at all these various things. We actually have other pockets of cash. We have other levers we can pull.
That was just kind of the one tax item.
Right, right.
Yes, absolutely. But it does show that the model is a difficult one, where our main source
Very
of
difficult.
revenue is just a formula. Really doesn't look at what might the community have to do in that upcoming year. It's really just a formula for your base taxes. So it's our starting point, but it's a difficult formula to work with.
And state aid, I just consider part of the run rate. We just build state aid into our operating budget year over year with minimal increase.
Yes.
Thanks. This was great, Pam, by the way. We
gonna-
had talked about this for a long time, so
Yes.
we may have put some people to sleep, but I thought this was a great way to do it.
Yeah,
Great
it's-
way to put this like. Keep going.
Quickly, your next slide.
Pam's not done yet.
One item we have to provide for in the budget, unfortunately, it's a big item each year, is the fixed cost budget. So in our current year, we spend $13.8 million on our employee benefits, 1.4 million on our insurance and reserve accounts. So $15.2 million total in what we call fixed cost. So those employee benefit costs are our pension cost, our health care, our payroll taxes, unemployment, workers' comp, all of that. And it's for all of our employees, school and municipal. It's a very large item. When we start our budget, on the next slide, we're looking at what's the increase in that category. In a sense, it's really the first category that we have to make sure we're funding.
Right.
So we already know, our estimate right now for FY '21 is that's $920,000 that we would need to set aside for that bucket. So that's
New. That's
quite
an
a chunk.
increase.
And that's typical. Those include our pension assessment from Norfolk County, we know is $5.7 million. They're on a fixed funding schedule. So we know that number. It's a 7% increase over the current year, $381,000 increase. The health insurance budget, our projection is $6.5 million. We're using a 5% estimate at this point, $310,000. Our other fixed costs, about $200,000, and then the OPEB, as I mentioned before, $25,000 increase to stay on that funding schedule. So quite a large piece of that new revenue has to go towards this. The health insurance will keep that estimate at 5% until later in the year. The GIC usually comes out in February with plan design and March with the final rates. We have more information as we get closer to that time, but that number is an estimate only.
Pam, when I first saw this, I thought the insurance payroll tax estimated increase was high at 10%. Is there a driver of why you have 10%?
It's an estimate, rough estimate at this point. One of the drivers is that one of the payroll taxes municipality pays is a Medicare match. Town and school employees do not pay Social Security. They have to pay a Medicare tax, and the town has to match. And when that new tax came on, it was at a certain point forward. As we have staff retiring out, all new staff is required to pay that tax.
Oh, I got it.
Some of the people who retired
Weren't paying
out
it.
weren't part of that. It came on
Okay.
at a certain point, it was just everybody
so it's-
forward.
So as they age out, the new group
They
is
age out.
paying, so we're seeing an
Before
increase.
that, municipal and school employees were not eligible for Medicare because they never paid into the system.
Right.
So that tax came on. So we have some of that acceleration in there. But that number we will firm up as we move forward in the process.
So that makes sense.
Pam, does the town pay the Family Medical Leave Act The new tax that just went into effect, does the town pick up a portion
Well,
of that?
that's interesting. The new state law on the payroll
Exempt.
taxes for family medical leave, we are exempt.
Okay.
And I think basically because we really already have those types of policies and coverage in place.
Okay.
But I know other businesses that's all kicked in, and the state did not exempt themselves, and that has come in place. We're fortunate that we don't have to add that into this mix.
Not yet.
Wanna-
That's a pass-through. There's no added cost, no matching from any entity. It's just a pass-through.
No,
No.
no, no, no. It's
Oh, the
50-50.
employers, if you have over 50
Oh,
employees.
okay, I'm
And
sorry.
it's not a must.
Deal with the small
It's
ones.
not like Social Security. It's a may. So you actually, for collectively bargained employees, you have to bargain it.
Yes. So we do not have that in that
It's
number.
not like Social Security. You don't have it yet.
Really getting to the
Yeah.
final, I promise. So that's the fixed cost. When we look at the operating budget, we mentioned, that's the largest area of our spending. Our combined school and municipal budgets are about $68 million. And all we're showing you right now is just roughly what it costs us to increase those budgets. So a 2.5% increase to both those budgets is about $1.72 million. So each 1% increase, 687,000. It very quickly adds up, and you see very quickly the difficulty in fitting everything into our revenue allocation. Final slide, this is the capital, again, in the current year, 2.3 million, and we would look to replicate that for FY '21.
Did you say that last?
Final slide.
Final slide, thank you, okay.
Good job. Any questions before we wrap up? This is going to be an ongoing process. Really? You got to go back to the mic. You got to go back to the mic.
Just a quick question on the property values. Could you refresh my memory as to when we do the valuation for, the reason for the question is, when do we start taxing the condos at University Station? So what's the timing of when they come on the tax roll versus, and then the impact on the budget?
Yep, so the values each year, the values on what we will tax in the current year, FY '20, is property values as of January 1, except for new growth, which runs until June 30th. So to the extent of what was online by June 30th, we are allowed to add into the current valuation. So the assessing department is completing that right now and going through the review process. Again, at your meeting in November, when you set the tax shift, you will have all of the value information. So what's come online by June 30th down at University Station will be in this year's taxes.
Probably reflecting the investment of construction dollars versus market value
Right.
on the condos at June 30th.
It would be the following budget.
Correct.
And then if not, it comes in the following year.
It's still new growth to the extent that construction dollars are new, and there's a tax on it, but it's not at the, again, the more assessed value, market value, closer to market value. Okay, so this is part one. Big discussion at November 18th. Split tax rate, capital discussion, and more to follow. I want to thank people for, one, their patience, because this is a lot of material to take in. I'd like to ask that when we post this, and Westwood Media does that, if we put it on our town website, we also have a link through to this document so people can print it out if they want to. I'm sure it will be showing on the visual display, but there is a lot of great information here that it will come up again, and we'll talk about it some more, but the financial policies, where we are, there's a lot of information, and the blending of capital and operating and revenue and everything else can sometimes get a bit overwhelming, so I think it'd be good to have this available to people who are interested. And certainly, there'll be a lot of people who will be interested as we go through the process and discussions with Finance Commission leading up to town meeting.
Yes.
But
And-
excellent
and
job,
Thank you
Pam.
for the time, and again, we've tried to do this so that we're not going again and repeating it to all of
Right.
our other groups.
Right, yeah, well
That's
done.
the way to do it. Thank you.
Thank you for people who came out for that. We appreciate, and your work, everybody's work on it is very much appreciated.